Good afternoon, ladies and gentlemen, and welcome to the Good Energy Group PLC interim results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and we'll notify you when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, we would be most grateful. And I'd now like to hand over to Rupert Sanderson, CFO, and Nigel Pocklington, CEO from Good Energy. Good afternoon.
Good afternoon, Mark. Thank you very much. Just to introduce myself, those two names, I'm Nigel Pocklington, and I'm the Chief Executive of Good Energy, and a very good afternoon to everybody who's joined us today. So just to get us started, we move on to the next slide. I suspect many people on this call are very familiar with the company, but just to, for those who perhaps aren't, Good Energy has pretty much a 20-year history, initially as a generator and a company that raised money behind generation, but more recently as a supplier of 100% renewable deep green energy and as an energy services company, so trying to marry digital technologies with our provision of green energy to help people adopt ways of using energy which will help the climate crisis. And that is how we very much see ourselves as a future-facing energy services business. There's one other piece of business I need to attend to before we move on to the agenda, which is, as I'm sure as many of you are aware, we have received an unsolicited cash offer by Ecotricity for Good Energy, and that is a process that's ongoing. Because of that, I want to let you know that, and to save you from asking questions that we can't answer. We're very limited in answering questions around that particular offer. If you would like more information on the Ecotricity offer, and indeed Good Energy's board's very strong recommendation to our shareholders that you reject the offer by taking no action, so literally doing nothing, then please visit our website, that's goodenergy.co.uk, and within the investor centre on the site, you will find a microsite entitled Offer for Good Energy, and all of the materials around the offer, particularly our defence circular, where we lay out the arguments as to why we think it is in our shareholders' best interest to reject the bid, can be found there. As a result of that, we're obviously going to present our results to date, but we are limited by the takeover rules in terms of how much forward-looking information we can provide there, and certainly in the Q&A at the end, if occasionally you find us point blank not answering something, then that will be the reason why. Right. In terms of an agenda today, what are we going to go through? Well, after a few introductory thoughts from me on the main themes of our first half, I'm going to hand over to Rupert. He'll take you through the highlights of the financial performance. Then I will resume the presentation just to walk through what I think some of the operational highlights of the first half of the year are, and actually to begin to set out more detail about where I see the future strategy of the company going. So just in terms of an overview, for those of you who are following the company, you will be familiar with this. I have been Chief Executive for about 4 months now. So we're obviously not quite ready to share a full and detailed strategic review with our investors. So I'm going to use some parts of today's presentation to give you a sense of both my views on the business as the relatively new CEO, its progress, and our future strategic direction. And I've got 3 headlines, really. The first is that the first half of 2021 has been one of strong performance from Good Energy. So financially, you will see, I think, clear evidence that we have weathered the storm of COVID. Of course, we're comparing against the first lockdown period in 2020. And that performance, along with some improvements to our balance sheet that we've already announced, means that we have today announced the resumption of our dividend. That's something that was paused temporarily as a COVID precaution. And we're now in a position to restart our dividend payments, which Rupert will take you through a bit more detail later. So a strong start in terms of financial performance, but actually also I think a half year of good achievements of milestones in terms of the development of our strategy, which is really around marrying digital platforms to help consumers and businesses adopt green energy and consume it intelligently. You'll hear a bit about ZapMap's growth and the new tariffs we've launched for EV drivers, our progress in terms of rolling out smart meters, which are key enablers for some of these new propositions, and about our plans for our customers who generate as well as consume power. And we'll also focus unashamedly, frankly, on the business's core purpose, carbon reduction and the adoption of clean energy. I came in at the tail end of this particular campaign, but I think the team have had a real success in the first half of the year in terms of raising greenwashing up the public agenda. And you can see that both consumers, players within the energy industry, and now government are taking note of the campaigning we're doing around the fact that not every tariff which is marketed as green is actually green. And I think that is very good evidence of the company really fulfilling its purpose. So if those are the headlines, I'm going to hand over to Rupert to take us through the financial performance for the first half of 2021.
Thank you, Nigel. Good afternoon, everybody. So I'll start with our profit bridge from half 1 20 to half 1 2021. So a really strong P&L performance in the first half, with an underlying profit before tax of 3.9 million and a reported profit before tax of 4.8 million. And obviously a very different story to the first half of 2020. So I'll just take you through a few of the moving parts within the period. The most substantial is, as Nigel says, is we're comparing against the corresponding period which had the first lockdown between March and June 2020. And we had three impacts really in that period, which we are reversing in 2021. So that was a relatively sharp reduction in demand, particularly on the business side, the need to sell back that excess power to an oversupplied market. And we put in additional debt provisioning at the end of June, given the uncertainty at that point in time as to the wider impact on households and businesses from the pandemic. So that's by far the largest sort of movement between the two periods. If I go along, we've seen a continued increase, particularly in our business demand, and we've seen growth within SME, our small and medium-sized enterprise business customers in the period in particular. And we have had the benefit of the sort of relatively low commodity price environment at the back end of 2020, and given some of our power procurement is undertaken over a longer period of time, we have seen a benefit this year compared to the corresponding period in 2020. Just completing the bridge, and then a couple of sort of more one-off items. So in the first half of last year, just after we had revalued our generation assets, there was one small solar site which we had to undertake an impairment, £600,000 impairment on that asset. And keeping with the theme of the generation assets, the refinancing of that portfolio at the start of April of this year led to a revaluing of that loan, and that gives us a small interest credit as a one-off item, which we're calling a non-underlying movement within our P&L. If I flick on then to the drivers of the sort of income statement performance, we have a small increase in our overall customer relationships in the period, and a slightly bigger increase in volumes. Most of that volume increase is in our domestic gas business, and most of that relates to weather. It was a colder Q1 compared to the corresponding period in 2020. So just going quickly down the income statement, that drives a small increase in our revenue. But I think the main piece to pull out here is our gross profit and our gross profit margin, which has moved up substantially. So we've seen a near 20% increase in gross profit in the period. and the majority of that, but not all, relates to the removal of the COVID impact in 2020. But the business growth and the commodity and hedging benefit obviously is a contributor to that as well. Admin costs are relatively flat when you take out the impact year on year on the additional provisioning on debt in the first half of 2020. And interest costs in the first half are relatively similar, but we'll start to see that cost now reduce going forward following the repayment of over 70% of the bond at the end of June of this year. Next, I will flick on to cash, and there are a couple of points to pull out here. So the strong P&L performance and the strong EBITDA performance shows the positive movement year on year at an operating cash flow before working capital level. There are a number of timing differences both within the year and year on year within working capital. There was in the first half of 2020, the COVID impact actually had a very favourable impact on working capital at the first half. So it's a slightly uncomparable period. But if we look at what's happened in 2021, there's two timing items that I would draw your attention to. The first is the way in which we have procured our renewable obligation certificates. That is a government levy in effect for renewable generation, and us, like any other supplier, has to cover that cost during the course of the year. We are quite unusual amongst other market participants is because we buy all of our power from renewable generators throughout the year. We are paying for those renewable obligation certificates as we go along, and there are just different timings from year to year in terms of the volume we have at a particular point, and so we have more renewable obligation certificates in stock at this June compared to the corresponding period, which will unwind in the second half. And the second, Nigel will pick up on the status of our NSEC billing system migration and rollout in the second half of the presentation. That's now completed, but during Q2 we were right in the midst of that migration, and there is a modest working capital impact, which again we see unwinding during the course of Q3. So that's the working capital piece. I think the two other points I draw out is obviously we have paid back over 70% of the bonds in the period, and so that is the main driver of our cash being lower than it was at the prior period. However, we still retain £9 million of cash at the end of June, having made that repayment within the period as well. Net debt and funding. So this is, we've shown this graph over corresponding periods, and there has probably been more going on through 2019 and 2020. But I would just highlight again that our medium-term plan of paying down debt continues. So we have all of our assets now financed within one portfolio. That is a relatively simple amortizing loan structure, so we will see that gross debt declining steadily over the course of the next 15 years. We've obviously made a substantial repayment of the bond in the first half of this year. There's a little under £5 million worth of debt outstanding on that instrument, and we have signalled our commitment to pay that down fully within 2022. So we can see over time that reduction in net debt. We can see over time the reduction in gearing, and we expect that to continue into the medium term. And then finally, just looking at where we are trading now, because obviously we have moved on a couple of months since the reported 30th of June period. So underlying performance remains in line with management's expectations. You will have, a number of people who follow the sort of energy industry and the energy markets will have seen that there has been a substantial amount of volatility and a sustained increase in commodity prices over certainly the last 12 months, but it's probably been most sharply seen over the last 3 to 6 months. And that will feed into our expectations of performance for the second half of the year, but it is within our sort of statement above in terms of remaining in line with full year expectations. And as I touched on some of the working capital items, we would expect working capital to improve through the second half of 2021. And then finally, as Nigel highlighted up front, on the dividend. So as we had previously re-signalled on our restart of the dividend programme, we have done that. We are recommending a payment for 2021, and we are restating our intention to maintain a progressive policy going forward. And the board has proposed an interim dividend of 0.75 pence, which will become payable conditional upon the hostile offer by Ecotricity Group Limited lapsing or being withdrawn. At that point, I will hand back to Nigel.
Thank you, Rupert. So I've been Chief Executive for 4 months now, and one of my thoughts are based on 4 months. I think, first of all, there are 3 things I wanted to focus on really. First of all, I can certainly confirm as a new incomer to the business that I think we have a well-managed core supply and generation business, that it is backed by modern and very functional billing and customer management systems for both our domestic and our business customers. And we have important and perhaps underappreciated capabilities and systems in core energy trading and long-term power purchasing. And these capabilities are delivering on a variety of metrics. They underpin the strong first half performance that Rupert's just taken you through. You can see them coming through in terms of our customer service, our price competitiveness, certainly within the deep green 100% renewable segment, and the general health of our P&L. I'm also going to focus on 2 themes, which as our strategy develops during my tenure as CEO, I'm going to refer to as energy as a service, and I think they're going to remain important areas of focus for us as a business. The first is really mobility as a service, where we are looking to support and really drive the fast growth of EV ownership by building both digital platforms that help people own and drive them more easily, but also providing fuel and other propositions which help people charge them in a green way. So I'll be giving you an update on that, along with what we would call generation as a service, which is really using technology to make it easier to consume renewable power more smartly, to share it or to generate it yourself. And we've got some important innovations coming through on that front as well. So let me give you a bit more detail on why I feel that the company's core is in good shape. Well, I think we've got all the building blocks in place we need to grow from here, and that is due to a lot of hard work from the team to get this far. So we've talked about Kraken before, which is the consumer billing and customer management system developed by Octopus Technologies. That is fully embedded in the business. It is absolutely what runs our domestic supply business and has been for a while. You can see it at work in a number of areas, really. All of the time of use tariffs that we've been able to launch, an innovation in proposition, is enabled by this more modern system. We've re-engaged with the price comparison sector, which obviously, having come to the business from Money Supermarket, is of personal interest to me. And again, that sort of faster moving, more nimble environment needs the sort of system that Kraken gives us. And we've seen our customer service levels improve. In fact, our Trustpilot score is better than the industry average. It's certainly better than our nearest deep green competitor. And that again is because the system has enabled us to organise our customer service operation in a way that supports this high level of service. And we're now in a position, I think, to do the same on the business side. So NSEC is a modern digital business energy customer management system. It is now the basis of all of our energy, our business to business energy services, and that migration has been completed over the course of the last quarter. There's been some short-term impact from migrating billing systems. There always is. If you think about it, particularly, you have to sort of pause billing in an old system to make sure you're confident it's running in the new one, and they get running again. So there's some catch-up to do in terms of billing of our business customers, but we have evidence that that is righting itself through this quarter, and by the end of the third quarter, we'd expect that short-term impact to be completed. And what does that mean for our customers? Well, it means that our business customers, for the first time, have an online portal that they can give a meter reading with or check their account details. And again, it enables further or quicker innovation in terms of business-to-business propositions. Smart meters, key to this. I mean, obviously, it's had a mixed press from a consumer's point of view over the course of the last 10 years, but certainly a functioning smart meter estate is a vital enabler for innovation in terms of energy services, and we have focused this year on increasing the number of smart meters we've got installed. After a slow start, which is what you might expect, given that we were in another COVID lockdown at the start of the year, we've seen 19,000 meters installed to date, and we should expect to be well over 20,000 smart meters within the business by the end of the year. And I think lastly, in terms of these foundations, so one of them has been with Good Energy for a while, but will remain important as we focus on innovation in terms of generation of service, which is our status as one of the leading players in terms of the administration of feed-in tariff businesses where people are generating as well as consuming power. We have over 175,000 fit customers and are once again trying to build new services to support them as they generate power. And this is all underpinned by a commitment to 100% renewable power, which is recognised increasingly by a lot of consumer and other bodies. You can see some of the brands there. So Which, Good Housekeeping, Uswitch, in terms of price comparison, has also done so, and that commitment will remain the case. And I mean, perhaps unusually in an investor presentation, but I think importantly, the company's wider purpose has really come to the fore this year, and we've been very successful in campaigning on a particular issue. So perhaps no surprise, but I think a lot of evidence that the public policy and consumer agenda is tilting towards good energy, with an increasing recognition of the impact of climate change and the nature of the climate crisis. And the IPCC report, which talks about Code Red for Humanity, a very strong use of words there, certainly actually caused a bit of a tick up in our trading, apart from anything else, as you can see people engaging with the subjects. I expect COP26 to do the same. Our focus has been on the labelling, effectively, of energy tariffs in the UK, where the majority of energy tariffs are now branded as green, but yet we know that the majority of generation certainly isn't green, and in fact very few of those tariffs really warrant that title. And we've been campaigning against this greenwashing, effectively, where energy companies can use certificates which are sold separately from the green power they're supposed to approve to effectively call a tariff green when it is not sourced from 100% renewable power. Personally speaking, I think this is something of a consumer protection scandal, and I can see that the regulatory bodies are beginning to contemplate action. We've seen some strong words from Anne-Marie Trevelyan, the energy minister, in the last month or so, and a call for evidence from BEIS, the business department, around precisely this issue. So we should expect the public policy wheels to turn, albeit at a slower speed. What's more gratifying is that other players within the energy market, as well as consumers, are beginning to take greater interest in this. And I think the initiative that has certainly had the biggest impact on us is that Uswitch, who are the biggest price comparison player in energy switching, have introduced a gold, silver and bronze accreditation scheme, really around the nature of the renewable energy that people are supplying. And we were very proud of our status as the only energy company with all of its tariffs given the gold standard by Uswitch. So if that is a belief that the core business of generating and particularly supplying renewable energy is in good health because of the work the team has done, both in campaigning and in terms of our core systems, let's turn a bit more to where we see the future direction of the company. As we've said, we increasingly see ourselves as an energy services player, more so than a generator and supplier. And really, our conviction is that we can use digital platforms and digital technologies to help consumers consume renewable power in ways that increases its adoption. And one of those is obviously the electric vehicle market. EVs are now the fastest growing segment in terms of UK new car ownership. And ZapMap is by far the leading app for the EV driver, really aimed at making it easier to use and drive an EV. One of the questions I've often asked about ZapMap is actually how defensible is it? We know there are a lot of technology players who do mapping and the like, and I would point to some of those data points as arguments as to why it is quite a strong defensive moat already. So its coverage is impressive, about over 250,000 registered users on ZapMap now, and you need to compare that to the fact there are only about 290,000 purely battery-driven cars on the roads in the UK at the moment, so their penetration of the EV driver segment is very considerable. That registered user number, by the way, shows good signs of growth within the business. It's about 70% higher than the end of last year and about just over under 40% higher than when we gave our preliminary results presentation in March. So there's good growth in registered users, but from the point of view of defensibility, it's the level of coverage that it boasts, with about 95% of UK charge points showing on the service, 70% of which with live data, and the amount of community content it is generating, which of course is another way of updating drivers as to which charge points are accessible or maybe broken and the like, which is continuing to give it a defensible position. And commercially speaking, it is beginning to hit some important milestones. So as you might remember, ZapMap effectively is a venture investment for the company. We've got a business which has grown a very strong footprint amongst EV drivers, and we are investing behind it to help them build out a business in their own right and to give us access to new and different revenue streams as well. And they've made strong progress. So ZapMap is now a subscription product, and that version of the app is available on both iOS and more recently Android. And whilst we're not releasing any specific details about that side of the business today, we can certainly see enough in terms of conversion rate and conversion of trialists into full paying subscribers to suggest that there is a real business to be built here, and we're going to try and invest and carry on doing so. Zap Pay is, I think, a very useful offer from ZapMap, which is really aggregating what is still a very fragmented landscape for EV drivers in terms of different charge point operators, different payment cards and memberships. Zap Pay is an ability to pay for your charging from your phone. There are 3 charge point operator networks live and a further 7 signed up. So pretty soon, maps that will be able to help an EV driver get from A to B, reassured that they can use Zap Pay wherever they go. And then of the other innovations they're working on, I think the partnership with FleetCor, where effectively we're going to enable fleet owners to have a good oversight of how their fleet of vehicles is working, much in the way that a petrol system does with FleetCor, will be out in Q4. So it's a strong innovation and delivery on milestones from ZapMap. And our EV play increasingly isn't just about that. I do think that is an important platform for EV drivers and gives us a very strong foothold with them, but we have followed that up by launching specific tariffs aimed at EV drivers, and we're beginning to see some considerable pickup in interest in those tariffs. And what the graph is showing you is actually the fact that they change consumer behavior quite considerably. In fact, on one of our early EV tariffs, we saw a shift of about 80% of a household's consumption into off-peak windows. And that is important, both in terms of a sign that these tariffs resonate with consumers, but frankly, in terms of our wider purpose, it's interesting because you're seeing a 43% shift in load into off-peak times, which will mean that the carbon intensity of the grid as these tariffs scale need not to be so high at those points. So that is where we see our EV platform going. The other big platform for us we would call decentralized energy. And if you've been following the company for some time, you'll know that this is pretty close to the roots of good energy. But here's my definition of what we really mean here, which is we want to help customers generate, consume and manage 100% renewable power. And increasingly we see digital technologies as being a way of doing this. So where are we really working and what have we done this year in this area? Well, the first, I think, really concerns our feed-in tariff business, which, as I said a few moments ago, is sort of the foundation of our interest in this. We're a major player in FIT as it is, and it's actually our systems that face into FIT customers, so meter readings, updates and the like, actually are beginning to look outdated compared with what we offer consumer and business customers. So we are investing behind our Fit business to provide a better service and better management capabilities. And I expect the first code to drop for that in October. It's been worked on by the in-house technology team, and that will be to enable simpler meter reading for single site customers. We're also working on reducing our reliance for those customers on what are called deemed payments, so effectively an estimate paying you for the energy you generate, and in favour of payments based on actual generation, which these new systems will enable, along eventually with making the whole business of meter reading and meter submission, which is quite a cumbersome administrative task in this part of the market, much more straightforward. So a big investment in Fit in terms of our own people and time. Smart meters we've talked about before, but they absolutely enable quite a lot of this innovation, and we're hoping to get over 22,000 smart meters installed in 2021 amongst our own customer base. They are what unlocks things like the EV tariff. And then finally, an initiative that the company has been developing for a while, which had been called the Consumer Access Device. We're going to market with the brand of the Good Energy Hub. And that is a simple plug and play device, which effectively takes data from your smart meter and helps you visualize it on your mobile phone. So you can increasingly both visualize which devices in your home are using what power, and then increasingly use it to deliver automated meter readings, particularly for Fit customers. And we think it's an important part of our mission, frankly, to use digital technologies to help people visualize what they're consuming and consume it smarter. And in fact, if we go over to another slide, you can see some screen grabs of how the app will look from the start. So that first screen grab, the front there will show somebody who's got their own solar panels, effectively how self-sufficient they are in energy terms. And then the pie charts behind are more the functionality, which really recognizes different consumption patterns of devices around the home, your fridge, your television, your EV, and gives you a visualization of how they're using power and how you might use power more efficiently. And we're hoping to get 5,000 of these devices rolled out effectively, and I suppose a large beta test by the end of the year. Marketing is already underway to gain interest from some of our core customers, and we look forward to seeing how this, I think, very good example of how digital platforms can help the consumption of green energy go from there. And so that's the end of the sort of formal materials we wanted to share. I'll just wrap up before we go into Q&A with a summary. And I think what we've said today is really Good Energy has a strong core business. It's spent a lot of time and effort getting into that place. But there are good foundations in terms of systems and our feed-in tariff business and our positioning as a deep green supplier, which gives us good confidence for the future. We're cutting through. We're not the biggest energy supplier in the market, but we have certainly had our voice heard in terms of greenwashing as an issue, and you can see both players in the energy industry and eventually government interest in this as a topic, and we will double down on campaigning in that area. We have seen strong financial performance. COVID was a difficult time for any energy company in terms of reduced volumes and increased uncertainty about consumers' indebtedness, and we've weathered that storm. And I think our first half performance shows that the business has recovered from that well. And we are seeing, I think, now a good run of innovation, particularly around either mobility as a service or generation as a service, two of our core themes, as we continue to marry digital platforms with our renewable energy as a way of helping consumers consume clean energy smartly. And I think that is the end of our formal presentation. So we're now happy to go into Q&A, and we can go through pre-answered questions or pre-asked questions and then anything that's come up during the meeting.
That's great. Nigel and Rupert, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. We'll send you an email when that's ready for your review. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation has ended, you'll be redirected for the opportunity to provide the company with your thoughts and expectations. Nigel, Rupert, obviously we received a number of pre-submitted questions, and firstly, thank you to those investors that took the time to submit questions both ahead of the event and during today's event. And I know you touched on the ecotricity, your ability to discuss, but I know you wanted to reference and address all pre-submitted questions. So if I may start with the first one, which reads as follows: are there any benefits to a merger with ecotricity? I find people generally are more likely to have heard of them. However, I try to promote Good Energy as the go-to green energy company.
Thank you for the question. Yeah, I wanted to sort of answer this, if only by sort of explaining why I'm not going to entirely answer it. So the rules for the takeover panel are very clear and very strict around what we can and can't discuss during an offer period, and they're intended, frankly, to make sure that all investors are seeing all of the information at the same time. And so all I can do in terms of answering that one really is to once again reiterate both the board's stance on this, which is that we do not support the offer. We think we're strongly advising our shareholders to reject it by taking no action. But we have developed a lot more material on this, which is available in the microsite I mentioned in our investor relations site. All of it is carefully verified by advisors, so you can't just sort of throw mud at this, as it were. There's some clearly developed arguments, and we're very clear that we think the offer would be a bad thing for the company to accept, both because we believe in our strategy as a board, if you like. We think that we have a modern and digital view on how the adoption of renewable energy can progress from here. We think that this gives us access to some markets which are really only just beginning to go mainstream and will show very fast growth from there. We've been very clear that we think the offer from ecotricity, which is a 10.6% premium to the price before they announced it, is undervalues our business considerably, and you don't necessarily need to dig into our financials that much on that. I mean, the average figure for businesses of our size is a premium of at least 44%. So there's an undervaluation argument, and we are very clear, again, from analysis just of their published results, that we don't think ecotricity would be a good owner for our business. We think their financial performance, which is often loss-making, their level of debt, their view on strategy within the energy market are things that would take us backwards and not forwards, and which is why we've been pretty unanimous in recommending that our shareholders take no action. But I think that's all I can really comment on, all of which is already available and in the public domain. Let's take the next question.
Thank you very much indeed. Next question reads as follows: what plans do the board have to both retain and reward long-term customers?
Thank you. Thank you for the question. So it is true that whilst there is a considerable amount of churn in particularly the domestic energy market, generally speaking, Good Energy customers are stickier and they're more loyal. And particularly customers who are taking other services for us around, say, feed-in tariffs. And so I would say a lot of the investment we're doing is around kind of earning that loyalty and securing it. So in the feed-in tariff world, a good proportion of my engineers are now working on improvements to our feed-in service to both make it easier to work with us effectively, but also to potentially allow higher income streams for some feed-in tariff customers. So I think that will be a considerable bonus. And then for the wider consumer group, I think the Good Energy Hub, which I talked about there, is the kind of idea we're trying to develop, where we're going to try and make it easier and simpler to consume and manage green energy. So those are a couple of initiatives I think that will particularly reward our loyal customers. In terms of financial reward, I think the main thing we do is a promotion around customers recruiting other customers, which you'll see on social media at a time. But those are the real plans we've got there.
That's great. Thank you very much indeed. What are the key constraints to growth of the business, and how does the board propose to really overcome them?
Well, you'll see the board's arguments in quite a lot of our defence materials. So actually, we think we're facing against what are likely to be fast-growing markets, particularly around the adoption of electric vehicles, fastest-growing segment in the UK car market, and particularly around interest in new technologies around home generation. So we think there is kind of good underlying growth available to us in our sort of innovative markets. There is increasing customer interest in what green energy genuinely means, and obviously increasing regulator focus on it, which we think should fuel demand growth as well. So on the demand side, we should be able to benefit from growing demand. I think the constraints, such as they are, is obviously we need to do that in a way that is responsible given the nature of the energy market. So we're not going to go all out to acquire vast numbers of new customers if we're not confident we can't cover their demand in the energy market, and obviously cover it in terms of renewable power. But there's a lot of potential in this business, as we've said, in our defence material, and we look forward to going after it.
Thank you. I think you may well have touched on this in some detail, but we did receive a pre-submitted question that asked to provide a little bit more commentary on cash flow and debt policy. I didn't know whether there was anything there that you wanted to add to perhaps what you've already.
Do you want to take that or reiterate that?
No, so happy to do that. So I think we touched on some of the movements within debt. So very much our policy is to continue to pay down the debt on the generation assets, having put that all into one loan group earlier this year, and with a long-term visibility on that. The second point is around the repayment of the bond, both the approximately 70% that we did in June of this year, and the commitment to pay the remaining element of that by the end of 2022. And then probably just quickly on cash. So I think in terms of uses of cash within the business, obviously the core energy businesses needs working capital to operate. We have seen some of our cash deployed into businesses such as SatMap, and we have restarted the dividend. So I think that we'll sort of continue to consider those as the main sources of the main uses of cash within the business.
That's great, thank you. And the final pre-submitted question from Nick, a long-term shareholder, reads as follows: would Good Energy ever look at allowing users and shareholders to pay up front or invest in generating devices along the lines of bonds or cooperative schemes, so aiming at increasing the Good Energy self-generated energy? Was the last bond scheme seen as a success by the company, and would it be possible to create a scheme that could be counted as a carbon offset scheme? So a few questions in that one.
Let's pick that up. If you would just deal with the sort of the bond and its use and our feeling towards it, Rupert, and I'll take some of the ones if you like.
Yeah, so the bond, we've had two bonds over the course of time. The first was very much focused around generation asset development. The second focused around some of the developments that we've talked about really over the last sort of couple of years. It's always a possible source for future capital, and depending on the scale and nature of the developments we have going forward, it is one it's always in our consideration and armory.
Great, thank you. So yeah, I think just to reiterate that the bond definitely a success. When we announced the repayment, which is really us meeting our commitments, we talked a bit about what we'd used it for, and actually some of this work on fit is the tail end of the bond usage. In terms of the broader question, I mean, directionally, yes, although we've got no specific plans right now, but I think we are genuinely very interested in partnerships and initiatives around helping people install new solar panels. We actually have a partnership with Cashflow up and running to help people who want to get rooftop solar installed now. And there's obviously lots of innovation in this part of the market. And that would then bring innovation in terms of tariff from that point onwards. So potentially possibly not quite in the manner you describe, but I am interested in helping customers make these kind of installations, and what sort of partnerships or networks we can pull together with providers of finance or providers of installation services to do this kind of thing. And there'll be more on that as we develop our energy as a service proposition.
Nigel, thank you very much indeed. Well, that takes care of the pre-submitted questions. So perhaps I could direct you to the Q&A tab. You'll see a number of questions from investors throughout today's meeting. And if I could ask you to perhaps read out the question and where appropriate, give a response, and I'll pick up from you at the end.
Thank you. Well, shall we start, Rupert, with what looks to be a question about the wholesale market, which is obviously very newsworthy.
Yeah. So let me take the first one. So the first question is from Nitin T. Please advise if Good Energy financials will be impacted by the recent highs seen in the wholesale market. What portion of demand is unhedged and hence needs to be procured at the high market prices impacting the financials? So I would probably sort of highlight 2 or 3 things here. The first is that we touched on in the presentation that the first half of the year had benefited from a relatively low commodity market, and that we did expect there to be an impact in the second half of the year from rising commodity prices. In terms of demand that's unhedged, I think the key thing here to be very clear on is that we will always hedge the demand that we see for our customers. We have 2 main products. We have a fixed product, which is mainly across the business market and some of the domestic market, and what we call a standard variable tariff product, which is in the domestic market and some of the very small end of SME. So we will hedge fixed as those products are contracted. The standard variable tariff, as by its nature variable, we hedge over a much longer forward period of time, but that takes out the volatility in the market that we've seen over the course of the last couple of months. There are obviously variables. We have a sort of balanced portfolio of PPAs, so we will have AD plants, we'll have hydro, we'll have solar, and we'll have wind. We have a sort of range of those portfolios, and there's obviously variability in those from day to day. There's obviously variability in terms of customer demand, and so we have to manage that. But I think the sort of clear point is that we hedge all of that demand up front, and we know that that isn't always the case of all of the participants in this marketplace.
Thank you. And then I think Nitin has another question, which is around ZapMap's annual revenue in 2020 and forecast for 21. ZapMap's very much a new venture business. It's just beginning to build its revenue streams, and we don't disclose separate revenue for it yet. Don't forget, however, that we're the majority holder, but not the only holder. So at some point there will be some fundraising, and that will have more detail behind it. What we do disclose is the user numbers we've been talking about, so up to about 250,000 registered users, which is, as I said, a 70% increase so far this year. But it's a fairly early stage venture. We've got increasing confidence that a business can be built, and a business actually with very different revenue streams to the energy supply business. Subscription revenue is obviously recurring and very attractive if you can build it at any sort of scale. But that's about as much as we're going to disclose at this point. But I'm certainly very pleased with the progress the team are making and see it as a venture we want to continue to support. Competitors to ZapMap, JB with comments, white label. So next question is from Andy. Who are the main competitors to ZapMap? Why don't you do JBs with car manufacturers for them to white label the technology? So new car owners are automatically enrolled for, say, the first year with them and then subscribe. And they do this with Wi-Fi new cars. And it's a good thought, Andy. In fact, the team are in conversation with a number of manufacturers. It's already the case that the slightly more expensive of the 2 subscription packages on ZapMap is one you can use effectively in your dashboard if you're driving a car that's compatible. So that's the direction of travel for them, which I agree is a much better user experience. If you've got any experience with this, you'll know that these sort of deals take a bit of time to do, but it's something I would very much like the team to do, and I agree with you that it will help the adoption of both EVs and the platform. In terms of competition, there are clearly other players. There's a lot of competition in the charge point operator market. There are other players building maps, but I think ZapMap at the moment is sustaining quite a strong lead over the marketplace because of its penetration of this marketplace and because of its coverage of charge points and the amount of content it has on it. But it's certainly not a position we want to rest on. We do want to accelerate away from here. It's a question from David.
So question from David is another one on energy markets. So thanks for taking my question. I have one on the energy market in general and how this might impact you. There are rumours in the market that bulb energy is going bust. What do you expect to be the market impact given they have around 1.5 million customers? In the light of high energy prices, especially from August onwards, are these customers moving to a flexible tariff that might be higher than the current Ofgem tariff for September to March? Would this potential default impact you in any way? So again, I will take that. I won't comment on an individual customer, an individual competitor. But we have seen already over the course of the last couple of weeks, a couple of smaller companies go into what's called the supplier of last resort. Those will be picked up by another supplier, and the regulator very much looks to protect those customers as they move from one company to another. You are also right that the current level of commodity prices indicate that the price cap that was only set for the 1st of October you're going to have a market position where fixed price tariffs that are coming out are going to be higher than the price cap that has just been announced, indicating that when the price cap is set again in 6 months' time, it is likely to go up further still. So it's certainly an interesting period in terms of market dynamics. When companies do go into that supplier of last resort status, as I said, consumers are protected. So where there are market costs that are borne by those companies, they are effectively spread and smeared over the entire industry. So the biggest companies would pick up the largest proportion of those costs. We are a participant, so we would pick up a very small proportion of those costs as well.
So, question from Tom: is Good Energy migrating any of its customers to half-hourly metering as they install smart meters? If so, what are the operational financial impacts of this to the business? Thank you. I think if they're domestic customers, the answer will be no. So we are sort of half-hourly businesses for our larger business customers, which actually we've seen some reasonable growth in the first half. But no, we're encouraging installation of smart meters, which I think is a better experience for our customers and enables quite a lot of these innovations. But a domestic customer will still be getting a domestic tariff. What else have we got here? Some questions on energy. Sort of, we go back up slightly over there. There's from Nick on investing in energy storage systems, given the intermittent nature of generation. So I think from a sort of policy and understanding the market point of view, we've actually done quite a lot of work in this area. We worked along with some outside consultants on a report called Zero Carbon Britain, really arguing around how we can get to that target through renewables, and that obviously does involve a considerable investment in storage and storage technologies. There are some of these technologies and this hardware just beginning to become available to the domestic consumer. It's quite an interesting segment of the market. It isn't one immediately that I want us to focus on. I think what underpins quite a lot of what I'm saying today is that we are, a well-run, I think, but small to medium-sized energy company. We need to make choices about which innovations we're going to back, and for us, that's electric vehicles and generation as a service. We'll obviously keep a watching brief on some of these other segments. If there are interesting partnerships we can bring to our customer base, we'll do that. But we've no specific plans around investment in these areas at this point in time. Anything else we keep rolling down? Rupert, do you want to say the banking covenants? Obviously, we wouldn't release them, but we have a going concern statement. And
yeah. So the question here is the company operating within its banking covenants, and what are they? This is sort of reported on really within our sort of annual report, and the sort of going concern statement that we adopt at that point in time, and our auditors at the time sign off on. So yes, I can confirm that is the case.
Good. And I think we've pretty much come to the end of the questions that have been published there.
Indeed,
So
thank you,
I
Rupert.
suggest...
My apologies. Yes, I think you have done, and I was just going to say, I was just going to hand back to you before we redirect investors to provide you with some feedback. But just to say, I think you have addressed most, if not all, of the questions that have come through.
Great. In which case, thank you very much indeed for taking the time today to hear about our progress, and thank you for those of you who submitted questions, and we look forward to talking again to our shareholders soon.
Rupert and to Nigel, thank you very much indeed for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Good Energy Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.